Hello and welcome back. You're watching Dukascopy TV. I'm Natalie MacDonald. Up next, we're talking fixed income markets. I'm joined by Fabio Michienzi of BCM Partners. Fabio, thank you so much for popping in and joining us again. A pleasure to see you.
Pleasure to see you again, Natalie. It's always a pleasure to be here with you.
That's very kind. Okay, so today we are talking fixed income markets. How would you describe developments so far this year in 2014? Has there been a pickup from the doom and gloom forecast we had some months ago?
Well, fortunately enough, Natalie, we're living in a dynamic world, and investors do seem to pick up a lot of optimism, which reflects into the markets. Now, if we take a simplified macro pictures, as usual, we see different stories for different geographical areas. Now, starting from the United States, at the beginning of the year, you may remember we had some very poor weather, which has impacted negatively on the GDP growth for the United States. We were expecting a growth of 2.5%. It has resumed to be a negative growth by minus 2.9%. Now, I would have expected this negative growth to build up some pent-up demand for the second quarter. And in fact, the figures of the second quarter are a little bit disappointing. We're expecting a growth of 3%. It has stopped at 2.5%. But on the other hand, you know, this low interest rate environment is definitely favoring the real economy. And it's particularly true for unemployment, which in the United States has been resolving from 7% to 6.2%, and in an improvement in the balance sheets of both companies and households, which has resulted in increased purchase power and ultimately reflects in this bull market we're seeing all over. In Europe, it's a different story. In Europe, I'm afraid the European Central Bank is still trying to jumpstart a sluggish and dormant economy and to fight risk of recession and of deflation. If we go in the Far East, we were talking about China, and China still represents a big problem for the real estate markets, for the developers who've been suffering, and this sector may spill over its problems to the whole economy and also influence and impact negatively anyone who's exporting goods to China. We were also talking about geopolitical risks, and although they've been subsiding in Ukraine, or seem to be, they've been increasing in the Middle East, and we are particularly watchful about the Shiite-Sunni conflict, which may have dramatic effects into energy prices. In India, we've seen international investors enthusiastic about the outcome of Mr. Modi's as a Prime Minister, and it is perceived as the right way forward towards the reform which are much needed over there. So there is a very complex and interesting picture out there where investors seem to pick up the silver lining instead of the dark cloud. And we've seen relentless rallies in equities market. We are experiencing extremely low volatility, and also yield spreads have been compressing dramatically. However, geopolitical risks that have receded in some areas have worsened in others, and such has been the case for looming financial bubbles. And this phenomena could really bring some economic shocks and financial instability. This is exactly what I call tail risks, against which any wise investor should always have a hedging strategy in place.
Where is the value then at present for you? Earlier this year, you noted Italy's corporate bond market, for example.
Well, to be honest with you, Natalie, I do not see much value left out there. Since we last met, as we said, spreads and yields have compressed dramatically. And also equity markets are overvalued in many clusters. All this has happened in a world that has been living complacent because of unlimited support from the central banks with monetary policy, because there was an economic growth, although slow but continuous, and this sentiment has depleted a little bit of value all the markets, and I do not see much value left out there. And we're talking about developed markets, of course. I still see a lot of value in Asia. But the big question here is whether the investors are prepared to take the plunge and go and explore out there. It's a different way of investing. You need a lot of skills, a lot of knowledge. We have seen, for example, last summer in 2013, how emerging markets were heavily dependent on the liquidity of the Federal Reserves, and how a return of situation has meant dramatic issues for emerging markets. We also have seen what has happened in China with the crisis of the shadow banking systems, and how this may reflect in the overall economy, whilst regions experiencing an election season like India and Indonesia still have to reassure investors that their trust is well placed. So I will look much more at developed markets and at this trade of relative value between the yield curves we were discussing earlier on. What I really look for is for a normalization of the monetary policy, starting from the Fed, that will bring a retracement from the low yields we are experiencing now, and a correction, a healthy correction of equity prices. It's overall a showing of a much more valuable path for investors, which could bring value and volatility back to normal levels, all this within an increasing and improving economy.
Where then are you also advising clients to avoid, perhaps, in terms of risky markets as the year continues also?
Well, this is the $1 million questions everybody would like to have an answer for. But I would make maybe 3 examples in as many different economic areas. So starting from the United States, I would advise investors to shun off the back end of the yield curve, since a different step from the Federal Reserves in the third quarter may be damaging for anyone who's long duration, so stay short duration in the United States. In the Far East, I would see another cluster to avoid into the real estate market in China, and anything that is related to the developers and the real estate. Whilst if we stay in Europe, I see a major risk in Sweden, where the Riksbank has been inappropriately raising rates at the beginning of the recovery cycle to cut them back by 50 basis points at a 0.25% nowadays. Now, interest rates at extremely low level are not always bearing good news, and this is particularly true if you consider that in Sweden the household indebtedness reaches 175% of disposable income, and all this in a real estate market which is overvalued according to the International Monetary Fund by 22%. So I would definitely be aware of Swedish central bank or Swedish banks who are heavily exposed to the mortgage markets.
Fabio, thank you so much for coming in and joining us and sharing your expertise with us. Thank you.
Thank you to you, Nada.
That's all we've got time for right now, but thank you very much for watching. Goodbye.